Right now, global stock markets are flashing red. Equities, the shares representing ownership in public companies, are experiencing violent swings, and the catalyst is thousands of miles away, driven by military conflict in the Middle East. We are seeing a completely bipolar market. One day, a political figure like Donald Trump hints at successful ceasefire negotiations, and the markets surge while oil plummets. The very next day, the Iranian regime publicly rejects those terms, and the exact opposite happens. Every single headline triggers an immediate, massive reaction. This erratic behavior traps retail investors, largely because of a psychological flaw known as pain bias. Human beings are hardwired to feel the sting of a financial loss twice as intensely as the joy of an equivalent gain. When the market drops on a scary headline, that magnified pain actually pushes casual investors into panic selling. While natural intuition suggests a retreat from the market, these specific geopolitical conditions are assembling a structural setup that has historically favored the patient buyer. To actually capitalize on this, you have to turn off the daily news alerts. Surviving this volatility requires looking under the hood and understanding the hidden macroeconomic mechanics that are actually driving the fear. The physical transmission of this panic starts right here. This is the Strait of Hormuz. It is a vital geographic choke point that handles a full 20% of the world's daily oil traffic. The financial markets are incredibly forward-looking. The physical flow of oil on those massive tankers doesn't even need to stop for the damage to begin. Just the mere threat of a blockade or disruption in that narrow corridor creates enough uncertainty to cause immediate, aggressive spikes in global crude prices. Those rising energy costs bleed into the domestic economy. Everything we consume requires energy to manufacture, and it requires energy to transport from a warehouse to your front door. When oil gets expensive, the baseline cost of producing and moving almost all physical goods rises. This sudden spike in the cost of goods reignites severe fears of inflation, and this hits right at a fragile moment, exactly when the broader economy and domestic job numbers were finally beginning to stabilize. A territorial dispute on the other side of the globe has a direct, measurable impact on how far your paycheck goes at the grocery store. This dynamic puts the United States Central Bank in a terrible position. Normally, when the economy shows signs of weakness or the threat of a recession, the Federal Reserve executes a standard playbook. They lower interest rates. This makes borrowing cheaper, stimulates corporate growth, and injects fresh money into the system. Right now, their hands are tied. The Fed cannot safely cut rates to help sluggish economies if a spike in oil prices is simultaneously pushing inflation back up. The market's ultimate nightmare is that oil prices stay elevated for an extended period. If that happens, the Federal Reserve might be forced to intentionally reverse course and raise interest rates to kill the inflation. That move actively shrinks the money supply, chokes business borrowing, and risks triggering a severe recession. Economists compare this looming threat to the crisis of the 1970s. Back then, a brutal combination of a weak economy and high inflation, known as stagflation, required extreme, painful measures from then-Fed Chair Paul Volcker to finally fix. This chart illustrates pricing in. The market isn't dropping because a 1970s-style collapse happened. It preemptively adjusts valuations for the worst-case future scenario. As headlines shift the probability of that worst-case scenario, the market recalculates. That real-time recalculation drives the violent swings we see. The current volatility reflects a mathematical weighing of extreme fear, existing independently of confirmed economic failure. If we step away from the theoretical nightmares and look at the very last 100 years of hard market data, a very clear pattern emerges about how the U.S. stock market behaves during wartime. This chart shows the standard trajectory of equities when a major geopolitical conflict breaks out. Historically, the market suffers a steep drop in the first 30 days. This initial shock phase creates a prime accumulation zone where assets go on sale. The data then shows a predictable recovery. On average, the market claws its way back to baseline within 12 months, and by month 18 of the conflict, the stock market statistically pushes past its previous records to hit new all-time highs. Zooming out further, the disparity is massive. Over the last century, bull markets, periods of rising stock prices, last an average of nearly 5 years and yield huge returns. Bear markets, the periods of decline, typically last only a year and a half, with a fraction of the downside. The math is entirely lopsided. Historically, betting on the long-term upward trajectory of the American economy mathematically crushes betting on short-term disaster. The United States also holds a unique geopolitical advantage in this exact scenario. Because the U.S. is the world's largest exporter of petroleum in the world, it is largely insulated from the very supply chain shocks in the Middle East that are causing the global panic. This creates what is known as the safe haven paradox. When the rest of the world descends into geopolitical chaos and uncertainty, massive amounts of foreign capital flee their home countries and flow directly into the safety and stability of U.S. financial markets. For the rational investor, the strategy here is straightforward. You use this fear-driven volatility to dollar-cost average, meaning you consistently invest a set amount of money at regular intervals into broad market ETFs like the S&P 500, capturing the overall growth of top U.S. companies. Periods of extreme panic and supposed lost decades actually create immense wealth. They allow investors to buy into the generational, highly profitable companies like Microsoft or Amazon at rock-bottom discount prices. But none of this math matters without conviction. If you lack the discipline to hold your positions through terrifying headlines and chaotic red trading days, the statistical advantage is useless. Global volatility facilitates a massive transfer of capital, where assets move from emotional participants to those who maintain their position through the chaos.